Welcome to another video update by Sebold Capital Management. My name is Sean Sebold. I'm president and founder of Sebold Capital Management. So today on the update, what we're going to do is we're going to go through a quick look of what happened in 2024, how things were impacted, what we see moving forward. We are now in the early stages of 2025 and lots of moving pieces. So let's take a quick look in the rearview mirror and see how that's going to affect things moving forward. Okay, on our charts here today, so let's first start with the market in 2024. So let's take a look at the S&P 500 through last year. Looked really good. We only had a couple of dips throughout that year and ended up the year a little bit over 25%. So good year for the large caps. But keep in mind, of those large caps, most of that were dedicated to about 7 stocks known as the Big Seven. 37% of this index, where there's over 500 stocks in it, only are made up by 7. So that will be integral to how we position for 2025. In the small cap space have been beat up pretty badly over the last couple of years. It is significantly more volatile. So any kind of time that you're adding funds on a regular basis into investments, more volatility is generally better. So things like HSAs and things like 401ks are really good for small caps. So we saw that again this year, saw a lot of big ups and downs in small caps, but overall significantly underperformed the U.S. large cap. Well, back to the small cap here, something else that you want to look at with regards to small cap. As a result of the Sarbanes-Oxley Act, it is incredibly expensive to be a publicly traded company. Good small companies that want access to capital in order to grow generally favor the private equity space. So what's interesting is that the small cap, 44% of all small caps don't make money. So small cap's a unique environment now, and actually the mid cap here is actually the new small cap. So mid cap is what we're looking at here. Again, a little bit better than the small cap, bigger exposure to technology there. The light blue line here is the U.S. aggregate bond. So the bonds usually are the safe things. Well, when the interest rates go slightly up, just inch up throughout the year, you'll see that bonds generally don't make money, and that's what happened last year. Very little rates of return, less volatility than you see than the overall markets. Now you also see the commodities. So commodities are up and down, so that's usually a good indication of what's going on with regards to inflation. So we're going to see in a different time zone or a different time frame rather than just a one-year time frame, how commodities really did have a pretty big impact on the market. And of course, international. International also underperformed pretty much everything except for the bonds. Now, what's also interesting about the international space is, people look at that and say it's not growing. Well, international doesn't have a lot of technology companies in it, and the values are very, very inexpensive. So it's not a bad place to be, but it also doesn't have a lot of growth in it. So from a downside protection, international is a good place to be, not from a growth perspective. Okay, so that was last year. Let's see how these have been impacted over the last 3 years. We'll quickly go over a 3 and a 5-year trend here. So there we got our S&P 500. We'll remember that our markets did very poorly in 2022. 2022 is when we had the interest rates. They jumped up as a result of the inflation. So we saw all the equity indices get beat up pretty badly in the 2022, and then at the end of beginning of 23, we started to see those come back. So there we've got our mid cap, then we've got our aggregate bonds. Again, as interest rates go up, you'll see those bond prices go down. They really didn't recover over this 3-year time frame. And here's the big one. So that's commodities. Lots of inflation there. We saw those inflationary period go on. Now you'll see at the end of this 3-year trend, commodities were number 2 in the performance categories of all these bidding indices. But if you take out these big areas right over here at the beginning of the commodities, you will see that there was actually very little and actually negative performance over the last 2 years. Okay, now let's get to the 5-year trend. Again, just a little bit longer time horizon. We've seen good growth for the U.S. large cap. Small cap, again, we had lots of growth at the beginning here. We saw the underperformance from 2022 on, and our mid cap, which we would call our new small cap. Our bonds, done a very poor job, at least of creating capital. They have done a pretty decent job of lowering that volatility, as you can see through that chart. Here's your commodity jump, where we saw that inflation at the end of the COVID cycle. We saw that jump through, and then we've got our international at that space. So lots of things going on in the spaces. What we're looking at in terms of some of the other economic indicators as we go forward are going to have an impact on what we're seeing. So let's take first look at housing. So here's our housing numbers. Now, housing has been, I guess a good word is pathetic. There's our existing home sales. 2024 was one of the absolute worst housing sales markets on record. It was actually not the bottom, but it was number 3 in terms of the worst in U.S. history. There was a stat that the Realtor Association came out with the other day. 71% of all realtors in 2024 did not have a single transaction. So abysmal for the real estate business, and you can see why. We saw the prices go up. Prices generally have a very hard time coming down in an environment that the prices are just overvalued. So what you see is a slowing of that. Housing is a very big part of our economy, and it's having a big impact. Okay, let's jump to pricing. M2 is always our favorite look at what's going on with regards to how much money is in the system. So we did see when they raised rates, money supply went down, but now it's starting to crank up again. This is not a good sign. We start to see this consumer price index. We will start to see that come up. We also looked at another index, which is the prices paid index by the ISM. The ISM prices paid index actually had a big impact on the markets because of this guy right there. Okay, so prior to this jump, we had priced in 2 consecutive declines in interest rates that the Fed was going to make. When this happened right there, and we saw that big jump. I mean, that from here to here is a pretty big jump. That means that the market immediately priced those interest rate drops out of the market. We've been kind of on the bandwagon that we thought we'd see interest rate hikes in 2025. We think we're still on board with that as well. This index was a very big part of that. You can also see this in the yield curve flip. Now, this sometimes gets a little esoteric and a lot of data here, but here's what's going on. This is a 1-month Treasury. One-month Treasury generally follows the Fed pretty closely. So we saw the Fed right here start to lower interest rates. So we started to see, hey, the 1-month Treasury dropped interest rates. However, as we go out, so this is a 1 month over here, a 1 year, a 5 year, a 10 year, and a 30 year. Okay, so as we go out on these, we start to see right here at the end, we start to see where the Fed started lowering rates, the longer term rates go up. Say, what's going on here? So essentially what's happening in some of the longer durations, the 30, the 10, and the 5, is the market says, Fed, I don't believe you. I know you think you're trying to do the right thing, but we think we still have inflation. We think you're going to have to raise rates, and that's what's happening with regards to that. That is a bearish sign when it comes to equities, so something to look at. Now, here's one that's really interesting in the money market space. We have enormous amounts of funds sitting in money market. So this is over 6 trillion, almost $7 trillion sitting in money market. So that's telling us that even if we do have a pretty decent downturn, we're going to see a lot of those funds come into the market. So we're not going to see a massive 30, 40, 50% downturn, even though we are pricing one in, because there's lots of money that is not going into equity markets right now. They're going to money market funds. On the job openings front, so this goes to the point of, do we have inflation or do we not? Or excuse me, do we have a recession or not a recession? So we think we've been in a recession for quite a bit of time, but it's not showing up the way it traditionally does. Number one, the data that we get for job openings is not as clean as it used to be. Keep in mind, when we get job data, it's a survey. So think to the political process. How accurate have surveys or these polls been? Well, job openings data, that's pretty much the same stuff. We have not gotten a lot of really good response. The other issue, so this is job openings. So we don't see, we've seen a decline in job openings since about 2022 there. But here's where the ones get interesting, the unemployment rate. Now, we've seen a slight tick up in unemployment rate here, but nothing that says, hey, we're in a recession. Okay, think about it this way. Imagine you're getting unemployment and they offer you $425 a week. You can't really live on that. It's good that you're getting some money, but you can't live on it. So what do? Do you accept that and take the unemployment? Or do you go out and do you get a job with Uber? And what we're seeing is more people will take the job at Uber because they can make $1,000 a week. Okay, so when it comes to the employment number, so this is our unemployment rate, which is slightly ticking up. But what's really interesting is that a lot of people are not taking the unemployment checks because they can make a job that pays more that they can get by with. So here's the number that you want to think about. It is 7 million people now drive for Uber. So are they all in their identified best use of their time job? I'm going to argue not, and that's why there's some disconnect between the unemployment claims, and the job market right now. Okay, here's another one. This data goes back pretty far, it's back to 1939, but as we see this government employment rolls greater than the private employment rolls. Now, we've seen it come down a little bit in this space, predominantly because of COVID. Now, we need to see that gap, the unemployment numbers employment rate for government come down. That takes more money out of the private economy and it slows our job growth quite substantially. It slows our GDP growth quite substantially. So we do want to see that. Okay, so where does that leave us? So those are the big backdrops, the big data points that we see for 2025. So we're looking at 2025 as our known unknowns. So here's the thing we do know, but we don't know its impact yet. Valuations are extended. So the big seven are grossly overvalued from any kind of discounted cash flow perspective. Does that mean they don't go up? No. Does that mean they go down? No, the market can be stupid for longer than we can say it's overvalued. So we just have to know that and take risk off the table where we don't want to take it. Inflation is way underestimated. We do think we still have inflation. We're very concerned that the new administration wants to lower interest rates. We think that would cause more inflation if they are unable to stop government spending to a dramatic degree. So we'll see where the survey comes out on that one. The new administration has lots of things on their plate. Now, there are some talk about tariffs. All they do is raise prices. Well, they also are a good negotiating point. They also do impact how other countries act with regards to trade. So there's a little bit of game theory going on. So I'm of the mind that it really depends on what tariffs are put in, how global they are, and how it impacts and changes the current market condition. That's going to be interesting. We also, again, the interest rate path, we're not sure what's going to happen there. The tariff path, government expenditures. The government is currently spending at a rate of $7 trillion per year. We're bringing in about $5 trillion. We got about a $2 trillion gap. If that gap can close by at least $1 trillion, we might see interest rates not have to rise as much to kill the inflation. Surveys out in terms of how successful they will be with that. Regulatory environment. We could see a regulatory environment that starts to lighten up, gets a little bit more of a softer touch with regards to business regulations that could create more growth. Again, we'll see whether that's going to be able to be done with the right protections in place. There's going to be a lot of legal work done in that space to see where that goes. Okay, so all of this, what does that mean with regards to how we're positioning things? So number one, stay away from large cap weighted indices. So anything like the S&P 500 or the market-based funds, we want to stay away from. They're heavily overweight some very, very expensive stocks. Two, we're going to take a fixed rate over a floating rate over a fixed rate. So floating rates, if rates go up as we expect, good. If we have a fixed rate, if rates go up, we're going to see those prices come down. We're not going to like that. So we're going to stay with floating rate as much as we can. We're looking at private equity in the SMID place, which is SMID is small to mid cap. We don't want to see those big caps. The big caps in the private equity, like a SpaceX, are still grossly overvalued in our opinion. So small and mid cap private equity, those are all companies that all make money, different from the public markets, who are 44% don't make money. and they're trading at reasonable multiples, anywhere from 8 to 10 times earnings. So really a good space to be in. Floating rate private credit, that's where we want to get most of our exposure to. This is a much better way to approach the fixed income or the income market than right now in this environment over any kind of publicly traded debt instruments. So we're favoring that. We are now starting to step into private real estate. We think valuations have come down, where the majority of them have come down. We are getting some good yields on those, and the pricing seems to be favorable. We might be a little bit early to this trade, but we think the values are going to be there as we move forward. We do think we're going to have a continued dollar strength. We don't think Europe is using its muscle to create a good growing economy over there as much as it should. So we should see the dollar continue to strengthen with policies that seem to be pushed for this by this new administration. So that's what we're looking at for 2024 and 2025. So there will be some portfolio changes that we're going to be implementing. Keep in tune to our market updates to let you know what this administration is doing, how it's going to impact the markets and your investments going forward. So it's going to be a really interesting year. Hopefully we'll keep it moving in a positive direction. That would be ideal, but we do expect some increased volatility. We do expect a potential 20% downturn somewhere in this market due to some changes in some of the market's ideology with regards to how policies are going to be implemented. So that is certainly a potential here that we do want to mitigate as much as we can. So looking forward to a positive 2025. So like to see you along the ride, and we'll talk to you soon.